All right. Today is Thursday, December 2nd. This is a recap for the stock market activities today. Folks, I got a good one for you tonight, and let's not waste any more time. In focus. Let's decode this crazy market and the moves that we're seeing right now. Then we have bad news from Apple. It is not just a supply problem now, it is also a demand problem. And lastly, a China update. We start with the market move. What's going on here? Because the market rebounded higher today, the SPY, the Dow Jones, but specifically the Russell 2000. The cyclical/reopening names led the rally, the rebound today. So what's going on here? Remember this, when the thing was announced back last Friday, November 26th, this is what I tweeted. Regardless whether the variant is serious or not, you will always get the thing that shoots the other thing for the other thing for that thing, optimism, which will produce rallies that will reverse the rotation. So the rotation of the rotation. Great trading opportunities ahead. And I provided you with the scenario analysis that if we get news that the thing is not that serious, then this will push inflation expectations higher. Therefore, the 10-year yield higher, the dollar higher, commodities higher, the IWM higher, the reopening names, but it will not be so good for the NASDAQ and the mega cap, growth, and momentum names. On the other hand, if the thing is serious, meaning lockdowns, panic, it's the end of the world kind of thing, this will be bad for inflation expectations, and therefore it will be bad for the 10-year yield, also bad for the US dollar, and initially for commodities. It is also bad for the reopening names, the cyclicals, the IWM, but it is good for growth and momentum, aka the NASDAQ. So far, the market behavior has been supportive to scenario number 2, until today, of course. Why? Because the setup from the get-go was we have an oversold market, and we're looking for a rebound, at least in the short term. And then you sprinkle a little jab optimism on top of that, and you have a rally, specifically led by scenario number 1, aka the IWM, the reopening, and the cyclical names. And this is exactly what happened today. Why? Because we got news from Moderna. We have an executive that came out and clarified, quote-unquote, clarified the comments from CEO Stefan Bancel that shook the market earlier this week. And now this Moderna executive says the company could have the thing or a booster for the thing ready in March. On top of that, we have Novavax. And now Novavax says it could start making a jab for the thing starting in January. But perhaps most importantly, the President of the United States, Joe Biden, came out and said he doesn't want lockdowns and doesn't want to expand the jab mandates. What is that supportive of? Scenario number 1 or scenario number 2? The answer is scenario number 1, that the thing isn't as serious as we thought, at least for now, and therefore it is good for the cyclical and the re-inflationary side of the stock market. I know what you're going to say, but bro, what about the NASDAQ? The Qs closed in the green today. Yet when you look at the heat map, what is lighting up green? The inflationary trade of banks, oil, industrials, and materials. On top of that, the cyclicals, the reopening names, the IWM. But the mega caps, the growth and momentum are actually down. Microsoft down, Apple down, Meta down, Amazon down, Tesla down, so the market is behaving exactly as we are expecting. To illustrate this for you, that if the thing is actually bad and causes lockdowns, yada yada yada, that will be actually good for the NASDAQ, tech, growth, and momentum. Illustrated by this chart, we have the RKK, we have other YOLO momentum kind of ETFs, and notice when they started to underperform. Remember, we got the news about the thing November 26th, last Friday. The slide in these names actually happened November 30th. They were actually trading higher before that. So why did the slump happen? The answer is Papa Jerome Powell evolving from a dove to a hawk. And that further illustrates that the thing is not in charge of the stock market right now. It is actually the Fed and Jerome Powell. And therefore, whatever pops we're getting right now, due to jab optimism or whatever optimism it is, they're going to fade away quickly until and unless we get a walk back from Jerome Powell. So yes, the scenario analysis regarding the thing is important from a day-to-day activities from an algorithmic trading perspective, but in the grand scheme of things, the Fed is in control, and until and unless the Fed reverses its stance, the hawkish stance, the market will have to suffer a little more. And somebody please pass the memo to JP Morgan, because JP Morgan says buy the dip because the thing might actually accelerate the other thing's end, okay? And I say no, because once again, all what this market cares about is the cocaine from the Federal Reserve. And yes, Jerome Powell might be playing a hawk right now, but if we get news, and we're about to discuss that, by the way, from Apple, if we get news that inflation is actually cooling off because the supply is getting hit, but also the demand is now getting hit, then maybe we have the window that Powell could reverse his stance and says, you know what? Yeah, we're not going to taper as aggressively because inflation is already trending down. And oh, by the way, we're going to bring transitory out of retirement. And that keeps the hope alive for the market. Ending the thing is not good because ending the thing involves the economy standing on its own feet and involves cutting the so-called accommodation from the Fed because the emergency is over. And therefore, have you noticed that emergencies never end in Wall Street? And by the way, why did Jerome Powell retire Mr. Transitory? Did Mr. Transitory get caught insider trading? Because that seems the only reason for anybody at the Fed to retire. Next, let's move on to the bombshell from Apple today. And mind you, just to set up the stage for you, we are starting to get news, evident by the Chicago PMI, the manufacturing PMI yesterday, the Fed's Beige Book, all indicating that the demand is also getting hit now. The demand is kind of cooling off. And if that holds, along with the commodities correction, then perhaps the inflation readings in December will actually trend down, and the Fed can have a reason to jerk off to. The problem is, what if inflation comes back again? Because Powell could say, you know what, inflation is slowing down, so we're not going to be so aggressive with the monetary policy. And then inflation pops higher again. And then we have to release a new variant. But anyhow, this is yet another evidence that the demand is cooling off in this economy. And oh, by the way, remember the trader who bought about $40 million worth of Apple puts yesterday with 2 days till expiration? Well, they know exactly what's going on. All of these insider trading activities, they get caught right here in this program, baby. But anyhow, here's the news from Apple, the bad news, of course. Apple has told its parts suppliers that demand for the iPhone 13 lineup has slowed down. Bloomberg News reported, signaling that some consumers have decided against trying to get the hard-to-find item. You know, the new colors on the iPhone, that's the new innovation from Apple. Apple, already suffering from a global supply crunch, has told its component suppliers that demand for the iPhone 13 lineup has slowed and orders may not materialize, Bloomberg News reported. This will be specifically bad for Apple suppliers because they're not going to get paid now. But here's yet another evidence that once the STEMI spending is gone, the consumer will dip into what? Into savings. And they're already dipped into savings, and savings are now trending below the pre-pandemic readings. And now the consumer is sliding those credit cards up and down, up and down, up and down. So the consumer purchasing power, the myth of the so-called great consumer, the strong consumer, right? According to Stephanie Rule, the consumer is better than ever. Not really. They don't have more cash to spend now, and this will be bad for all of these companies that enjoyed the STEMI impact in this economy, including Apple. I know what you're going to say. Is this bad news? Is this bullish news? Or is this bearish news for Apple? And I say, you know what? Don't listen to me. Listen to Thupathakal Dane Iveth, right? The propagandist for Apple, because he says that this is actually bullish news. Apple shares fall amid report of waning demand for iPhone, but Wedbush ups the price target for Apple, calling it a safety blanket in a market storm. This is, of course, the genius of the Thupathakal Dan Iveth. Next, let's move on to a China update. The Chinese crackdown continues, and now Chinese authorities have a new target in Macau. Macau casino shares plunge after executives arrested, and this happened yesterday. A major executive in Macau got arrested on charges of money laundering and other charges, of course. Today, casino stocks rallied higher on the jab optimism rally, specifically Macau casinos, the likes of Wynn Resorts, but you gotta be careful here because if the crackdown continues, it will deter the VIPs from gambling in Macau, at least for now. And this will be bad for Wynn and other Macau operators. More news from China, perhaps alarming news. Re the Evergrande and real estate crisis in China. China developers, these are the real estate developers, of course, face $1.3 billion in December bond payments. Now, as of late, magically, every time we get closer to a deadline and we say, you know what, Evergrande is about to collapse, it's about to default, magically, they come out with the money. But now we have multiple developers facing over $1.3 billion. You can kick the can down the road all you want, but the inevitable will happen. So we have a hawkish Fed. We have inflation surging out of whack, causing problems to this economy, perhaps pushing it into stagflation. On top of that, here's the other shoe to drop. If we have a major default in the Chinese market or a major slowdown in the Chinese economy, the market looks a lot less attractive than it was just a few months ago. More alarming news from China. Alibaba stock hits record low in Hong Kong amid delisting concerns. What are they talking about? We have a crackdown from China. China's reported plan to restrict overseas listings could mean potential stock market homecomings for the nation's largest tech companies, such as Didi and Pinduoduo. So you already have Chinese regulators cracking down on overseas listings. And today we got another bomb from the SEC. As the SEC moves a step closer to delisting Chinese companies in the United States. And therefore, we've been saying in this channel consistently so, avoid Chinese stocks. I know a lot of you like the Chinese names, specifically Alibaba, because it's undervalued. Yes, it is, perhaps the most undervalued company in the world right now. Yet we're going to stay away from these names regardless of how attractive they are in terms of valuations, and the reason is the uncertainty from China remains too high. Too much risk and uncertainty to be tolerated right now. And if that wasn't enough, we have even more bad news. As the curious case of China's disappearing ships continues, which is described as the latest headache in the supply chain crisis. Let's have this smarty pants explain it to us for our little heads to absorb.
Analysts say they started noticing this problem towards the end of October. Normally, shipping data providers are able to track vessels around the world because of something that's called AIS, Automatic Identification System. Those transceivers on ships enable them to send information, including its position, speed, course, and name, to stations based along coastlines via high-frequency radio. But in the past 3 weeks, the number of ships sending this information from mainland China, which is home to 6 of the world's top 10 container ports, dropped a whopping 90%. And industry analysts think they know the answer. That's because of a newly enacted Chinese data privacy law that took effect on November 1st. Now, this law requires all companies processing data to seek and receive government approval before such information can be sent outside of Chinese soil, apparently over the fear that such information can fall into the hands of foreign governments. Now, this law does not specifically mention shipping data, but experts think Chinese providers may just want to err on the side of overcaution, with one expert telling CNN that some stations along Chinese coastlines were removed in the beginning of November under the order of national security authorities.
So why is this a big deal for the supply chain crisis? Here it is. One chart shows the dramatic drop-off in ship tracking data from China. This could be a sign of worsening global supply chain crisis. You sprinkle a little of the thing on top of that, and now you know why Jerome Powell is becoming more hawkish. The data dropped off the face of the earth, as you can see from this chart, and here is why this is problematic. The increased availability and volume of the AIS data in recent years has become something the industry widely depends on, allowing shipping lines to predict vessel movements ahead of time, track seasonal trends, and improve port efficiency. Ultimately, these significant reductions we are seeing in the count of vessels signaling in China will reduce the availability to accurately monitor vessel activities, and this could have knock-on effects to already squeezed global supply chains. If this continues, there will be a big impact in terms of global visibility, especially as we come into the busy Christmas period, with supply chains already facing huge problems all over the world. And this is according to Anna Anastasisis AIS network team leader at Ship Tracking and Maritime Intelligence, Marine Traffic, told Reuters. So the bottom line, folks, the wall of worry is too high to climb right now, and therefore you're going to see the market weakening. Even though we have oversold conditions in certain markets and certain charts, the weakness will continue because the wall of worry is too high to climb right now. We need to eliminate some of the concerns here, be it the concern of Powell becoming too hawkish, or the thing exacerbating the supply chain crisis, or be it all of these concerns that we just discussed coming out of China. Anyhow, folks, this is the situation right now, but we gotta move on to cover the market here, starting with the market performance, and here we go. The Dow Industrial Average closing in the green, up 617.75 points, or a gain of 1.82%. The Nasdaq closing in the green by 127.27 points, or a gain of 0.83%. And lastly, the S&P 500 also closing in the green by 64.6 points, or a gain of 1.42%. What about the sector's performance today? Leading the pack at number 1 and capturing the gold medal, energy at number 2 for the silver, industrials. Number 3 for the bronze, REITs. And we're not going to shame any sector of the market today because every single sector of the market managed to close in the green. What about the advance to decline ratios? The NYSE 82% advancing versus 15% declining. The Nasdaq 65% advancing versus 31% declining. And notice the new 52 weeks lows versus the new 52 weeks highs. Not even close. We have bombs within these indices exploding every single day. And this is how you detonate a market, little by little, one block at a time. Moving on to futures. What's going on here? We have rebounds across the commodities market, specifically in energy, starting with crude oil prices, the WTI rebounding higher by about 2.75%. Meanwhile, crude oil Brent also closing in the green, gaining a little over 2% today. Of course, we had some bad news, quote-unquote bad news, from OPEC, and the reason is OPEC Plus, including Russia of course, have agreed to stick to their plan to gradually pump more crude, according to people familiar with the deal. And the number is 400,000 barrels per day. Now, the expectations were, the bullish expectations, the tailwinds in the oil market that's going to bottom, and it is a dip worthy of buying, yada yada yada, is the fact that OPEC still has control over supply. And the expectations were that they're going to say, you know what, with the rise of the thing and the release of the SPR, we got to cut down our supply increase hikes. But that didn't happen, and crude oil prices surged higher anyways. Now, the entirety of the market is rebounding higher due to oversold conditions, of course, so that could be it. But the explanations that I heard on TV, at least, were perhaps OPEC Plus is attempting to score some favors, some goodwill with the Biden administration. For example, Russia is looking for U.S. approval of the pipeline with Germany. The Saudis are looking for a deal with the Pentagon to be passed. I disagree. Yes, I believe that there is some political calculations behind the move of not reducing supplies from OPEC. Yet it is not to score goodwill with the Biden administration. It is not to appear, pay attention now, not to appear that OPEC is responding tit for tat to the release from the SPR and other strategic petroleum reserves. Meaning OPEC wants to avoid the appearance of a price war. And if they have to come at some point to reduce supplies or cut their hikes projections from 400,000 barrels a day to, let's say, 200,000, or even cutting output from the market, if they get to that point, the explanation will be not a tit-for-tat war with the Biden administration, but rather a response to the fact that the thing slowed down the demand in the economy dramatically. And this is, of course, evident from the statement that we got from OPEC today that reads, they will quote-unquote make immediate adjustments to production policy should market conditions shift. I believe that the oil market, if it continues to rally, is reading the market and the move exactly as I'm reading it right now, that OPEC will indeed cut the increases of supply, but it's going to happen later to avoid the appearance of a tit-for-tat war. Back to the commodities market, what's going on with softs? The rally in lumber continues to go on. We also have rebounds in coffee and cocoa futures. Meanwhile, cotton, OJ, and sugar pretty much closing at the flat line. What about metals? What's going on here? Yesterday, we got the divorce between gold and silver. Gold was rallying higher. just by a little bit, silver was crashing. Today we have the mirror image of yesterday with silver closing the day with moderate gains. On the other hand, gold is eating it on the chin once again, down about 1% today. Platinum closing at the flat line, while we have rallies here of around 1% apiece for copper and palladium. What about meats? Modest gains for live cattle futures. Meanwhile, feeder cattle futures on the flat line. On the other hand, lean hogs rallying higher by 2.5% today. What about grains? We have some bad news here regarding soybeans because China is cutting its U.S. soybeans imports after shipping delays, and this, of course, will reduce the demand at least in the short run. So I will be avoiding soybeans and sticking to wheat for now. Regardless, we had rallies for soybeans, soybean oil, corn, wheat, oats, canola, all popping higher, while rough rice closing with modest gains. On the other hand, soybean meal futures closing slightly in the red. Moving on to the big casino, the options market. What's going on here? Leading the pack by far, the hottest table in the casino, Apple, with about 3 million contracts trading hands today. About 71% of those were calls. The implied volatility in Apple is surging higher than the historic metric. And here it is at number 2, Tesla, the souffle, with about 1 million contracts. Only about 39% of those were calls. They are buying puts heavily. And I will share one of the trades for you in a second. But here it is at number 3, AMC, rebounding higher today, as we expected, by the way, due to oversold technical conditions. The problem is, they're now buying puts. Perhaps the pop is over, the oversold readings are corrected, and AMC will start to drop once again. Anyhow, AMC finished the day with a little over 500,000 contracts trading hands today. About 55% of those were calls. And here are the unusual activities that took place in the options market today, starting with the ticker EWZ for the Brazilian ETF. They're buying puts here, the 24 puts for the expiration date February 18th, with expectations that the EWZ will drop, matter of fact, crash by more than 20% by then. We have an inflation crisis in Brazil that is morphing into a recession. Anyhow, they paid about 75 cents a piece for these contracts, all in all, spending about $1 million. What about the trade for the ticker RCL for Royal Caribbean? They continue to buy calls on these cruises with hope that the thing is not serious and therefore we will see a recovery in airlines, but specifically cruises. In this case, they bought the 75 calls for the expiration date February 18th, with the expectations that RCL will pop higher by more than 9% by then. They paid about $5 a piece to enter this trade, all in all spending about $6 million. What about the trade for the ticker KRE for regional banks? And this is a proxy for yields, the 10-year yield. So if you're buying puts in the KRE, you're betting that the 10-year yield will continue to dive down, I should say. Anyhow, they're buying puts here for the KRE, the 67.5 puts for the expiration date, December 17th, with the expectations that the KRE will drop even more by 5% by then or more. They paid about 85 cents a piece to enter this trade, all in all spending about $900,000. What about the trade for the ticker MGM for, you guessed it, MGM? They're buying calls, the 48 calls for the expiration date, December 31st, aka New Year Eve, with the expectations that MGM will pop higher by more than 16.5% by then. They paid about 50 cents a piece to enter this trade, all in all spending about $500,000. What about the trade for the ticker DKS for Dick's Sporting Goods? They're buying calls here, the 125 calls for the expiration date, January 21st, with the expectations that DKS will pop higher by more than 10% by then. They paid about $4.50 a piece to enter this trade, all in all spending about $3 million. Now, what about the trade for the ticker ARKK, KKKK for Tesla Witch, Kathy Wood? The buying puts, the 94 puts for the expiration date, December 17th, with the expectations that the name will drop down by more than 5% by then. They paid about $2.65 a piece to enter this trade, all in all spending about $1.5 million. Now, what about the trade for the ticker OXY for Occidental Petroleum? They're fading the pop in oil here by buying puts in the name, The 27 puts for the expiration date January 7th. With the expectations, the name could drop down by more than 9% by then. They paid about $1.10 apiece to enter this trade. All in all, spending about $700,000. And lastly, what about the trade for the ticker TSLA? Tesla, the souffle. They're buying puts here. You cannot follow this trade because it expires tomorrow. But look at how gigantic the trade is. They bought the 1100 puts for the expiration date tomorrow, December 3rd, with the expectations that Tesla will drop below 1,000. They paid about $25 a piece to enter this trade. All in all, spending about $50 million with 1 day till expiration. Moving on to the heat map analysis. What's going on here? It is the re-inflationary theme, the revival of the re-inflation theme, and the reason is we have jab optimism, and perhaps the thing is not as serious as we thought. This is the sentiment, at least for today, and therefore banks are popping higher, energy popping higher, industrials, materials. But mind you, we were oversold to begin with, and therefore we have the tide that lifts all boats. Even the disinflation names, or sectors, shall we say, we're talking about REITs and utilities also popping higher. What does that say? The tide that lifts all boats. These are oversold rallies that fade right away and quickly. Yes, we're seeing the reopening names surging higher today, oversold bounces, short covering, yada yada yada. But the action in the big caps is not encouraging today. They're down along with the semiconductor names, AMAT, Lam, the infrastructure names, because now we have a major problem with Apple saying that we have a demand problem on top of the supply. What's going to hold the tech sector of the market? Because if chips go down, if the mega caps go down, can software hold? Well, software is rebounding due to oversold conditions, and that will fade away quickly, specifically if Powell continues to be hawkish. Notice the underperformance from Pfizer and Moderna. Pfizer and Moderna pop higher when the thing appears to be serious, but when the thing appears not to be serious, they get sold off, and the cyclical side of the market rallies instead. If you're still in doubt that today was not a reinflation trade and just an algorithmic reaction, look at the performance from Zoom, for example. The stay-at-home stock, it is down over 3%, further illustrating that today was a rebound, the tide that lifts all boats due to the oversold conditions. But you sprinkle a little jab optimism, and you have the re-inflationary side leading the market higher today, not the growth, tech, momentum, stay-at-home side. Moving on to the charts analysis, starting with the SPY, the S&P 500 30 minutes chart. What's going on here? We have the rebound day fixing some oversold conditions here, and now we have recaptured 453, you can say 453.11 if you want to be specific, for support. The problem is, what if this formation is a mere ABC formation? And soon enough, the SPY will take another leg down, the C leg, breaking the support of 453.11 and seeking support downstairs instead at 447. And what about the daily chart for the continuous contract on the SPY? What's going on here? We have a rebound candle, but it's not a reversal candle yet. And the reason is we did not close above the upper body of yesterday's candle. Now, the SPY could do that tomorrow, close positive, and that will confirm that we have a short-term bottom, at least for now. My hunch is the momentum to the downside is still so strong, and the wall of worry, specifically Powell being too hawkish, and to force him to reverse his stance, you're going to need a more aggressive shakedown in the market. This is not enough. This is not going to get his attention at all. Of course, the market could go either way tomorrow. And the reason is we have the non-farm payroll numbers. If they come out too hot, then it will be problematic for the market because it justifies Powell's hawkish stance. But if the cooks give us a slowing number, jobs being created, then this will be good for the market because it could, keyword could, convince Powell to reverse his stance. If we go down, we're looking for 4,594.5 for support. If that fails, we're looking for 4,472 for support. Moving on to the Qs. 30 minutes chart, what's going on here? Falling down to the support zone, piercing slightly below the support zone, and then bouncing higher. So far, so good. The problem is, what if this a bear flag formation and the Nasdaq will continue to slip in the days to come? I don't see a bottom here. I see a rebound. We're not going to say it's a bottom until the Qs recapture 397 for support once again. And here is the daily chart for the continuous contract for the Nasdaq. What's going on here? The head and shoulder is playing out, breaking the support the important support of 15,976 before climbing higher again. And the reason is we're coming down from an extremely high momentum move. And therefore, the market will try to crawl its way back higher to cancel the head and shoulder. My hunch is if Powell doesn't reverse his stance, the head and shoulder will play out and we have another leg down to come. What about the IWM 30 minutes chart, leading the rebound higher today and recapturing 218 for support once and for all? The problem remains, what if the IWM is just experiencing a dead cat bounce? And all what we're seeing right now is a bear flag formation, and the Russell 2000 will lose the support of 218 once again. No confirmation here that this is the bottom until the IWM recaptures 223 for support. And what about the Dixie? Again, the Dixie flushes down if the thing is bad, but if the thing is not as bad, then the dollar firms, because that solidifies Powell's hawkish stance that he needs to continue to tighten and taper aggressively, and that is good for the US dollar. But mind you, we are overstretched here and perhaps too bullish the US dollar. For example, when we look at the net leverage positioning on the US dollar, it is positive. Pretty much the consensus is the US dollar is bullish for now. Now, we're always worried about overcrowding. That doesn't mean that this is a sell signal for the dollar or the dollar is topping. It doesn't have to be, but you always got to be suspicious when the net positioning and the consensus is too bullish or too bearish on a single asset. Moving on to gold, what's going on here? Gold dropping down, the dollar is popping higher slightly, of course, but the other enemy for gold, the US 10-year Treasury yield, is rebounding significantly higher today, and therefore gold is dropping down to the Fibonacci support of 1,763. Could that hold and produce a rebound in gold? Well, that depends. You need to see the dollar losing 96 for sure as support, and you need to see the US 10-year Treasury yield also softening and losing the support of 1.375 basis points. Speaking of, here it is, the 10-year yield chart, what's going on? Rebounding higher, but I'm not buying it yet. I would prefer to see the 10-year yield revisiting 1.375 basis points. If that holds as support, then I'd be comfortable to say that the 10-year yield found support and it should continue to move higher. However, if it fails, then we'll know for sure that we have something else brewing here. And the message from the bond market, which we discussed yesterday, by the way, in details, is the 2-year will move higher. And every time the 2-year moves higher, volatility spikes. And the reason is it is a sign that the Fed is tightening and the Fed is about to raise interest rates sooner and higher than expectations. If the 2-year pops higher and the 10-year continues to drop down, then we have an indicator for an upcoming recession, warning Powell that being too hawkish right now will push the economy into a recession. But as we discussed before, perhaps Powell doesn't have any other choice but to push this economy into a soft recession to tackle this inflation. What about the TLT weekly chart? What's going on here? Still positive, still moving away on the positive direction from 149. Let's see how the TLT closes the week. The jobs report will be important tomorrow. If it comes out too hot, then my assumption is the 10-year yield will pop higher, the TLT will drop down, and vice versa, of course. And here's a chart for the VIX. This is a 4-hour chart. The MACD is still reading positive. We don't have any red impressions on the histogram, at least consistently. On top of that, the MACD indicator remains positive, trading above the neutral line of 0. What does that mean? The pop is excessive for now. It is overstretched, but it's not over yet. It is not over until we see red impressions on the histogram on the MACD from a 4-hour perspective consistently. And we see the MACD indicator curling down because, for all you know, this candlestick pattern in the VIX is a bull flag formation, and we have yet higher highs to visit. Perhaps tomorrow. Who knows? So keep an eye on this one. If the VIX starts to collapse, closing below 20, then that will be a confirmation that we have a tradable bottom, at least on the SPY. And here's the daily chart for Apple. What's going on? Here's another attempt, via options of course, to push Apple higher. Perhaps we have a whale who has a destination, a target, a number that they want to reach before a certain time. And they're using Apple's weekly options to manipulate the stock higher to reach that target before the expiration date. The problem is the news that we got today is absolutely not good for Apple, regardless of what Thupa Thacker Woodbush says. Doesn't matter. This is a battlefield right now. They want to close Apple above the upper band of the channel, yet we have the forces of the market also pushing Apple down, be it the jab optimism or be it the market sentiment regarding the shift from dove to hawk from Jerome Powell. And here is Tesla, a daily chart. What's going on here? We're seeing a lot of put options buying. Historically speaking, that usually fires back and results in Tesla popping higher. But we have high level of conviction here that Tesla will break the support of 1,000. It will be trading below 1,000 sooner or later. If it happens, then the bears have their confirmation once and for all to short and hit the stock hard, and that could exacerbate the move to the downside. You combine that with perhaps Reverend Elon Musk resuming the dumping. He dumped about $10 billion. He needs about $20 billion at least. So he has more dumping to do. You combine that with the technical analysis and the mechanics of the market of buying massive amounts of put options, we could see a flush down in Tesla. It is a battlefield for now. Highly interesting to watch, but I'm not going to participate in this game until 1,000 is breached. Moving on to tulips, what's going on here? BTC still holding, and it should pop higher any minute now. If it fails, run for the hills because the setup is bullish right now from a technical analysis perspective. We caught the support from the support zone between 53,200 and 55,300. What if this a bull flag formation? BTC should move higher, and the number one test will not be far away. It will be 60,351.51. And you can see in the MACD indicator, these red columns on the histogram are getting shorter and shorter and shorter, meaning the negative momentum is peaking, and perhaps we have a change in sentiment here from negative, bearish to bullish. Lastly, what about AMC? We have the rebound, the oversold rebound. It was not as impressive as I thought because 32 is still resistance. It is not support anymore. And of course, the most important observation here, what if this is a bear flag formation and sooner or later we're going to be knocking at 26 for support? This so-called rally in AMC is frizzling out quickly. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? The most important number, the non-farm payrolls, the cooks at the BLS going to be busy. And they want to serve us a cool meal, of course. Will they succeed? I doubt it because we have two indicators, the ADP report and the weekly jobless claims, all indicating that we should at least have added over 500,000 jobs last month. Now, the number will not be as important as the projection for the December number, given the rise of the thing. We also have the market services PMI, the ISM services index, factory orders, and again, an important Fed zombie speaking, James Bullard from the St. Louis Fed. Now, we know that Mr. Bullard gets high on certain substances and spills the beans by hawkish comments, off-the-cuff comments, which he's not supposed to do so, by the way. But the rebellious nature of Mr. Bullard sometimes result in a market panic when he becomes too hawkish or issues hawkish statements. Will be interesting to see, of course. But for now, folks, this is all I got for you. Thank you for listening. Thank you for watching. And I will talk to you again over the weekend.